That triggered a profit taking on put options, which in turn triggered a gamma squeeze, which caused stock prices to go up. That in turn caused margin calls on people who were short. Hi guys, it's Stock Curry, and we got bombarded with horrible economic news today. You would have expected the stock market to tank, but it actually rallied 3%. In today's video, I'll explain why, so let's get into it! The Dow closed up 3% after an historic one-day turnaround. The Nasdaq opened the day down 3% after the horrible economic news this morning, and then finished the day up 3%. It was a 6% intraday rally, one of the largest turnarounds we've seen in years. Inflation was terrible. You would have expected the stock market to sell off. But here is why the stock market rallied instead. There was no fundamental or earnings news that would have caused the stock market to go up. The most likely explanation is actually a technical one. The S&P 500 specifically, at its low of the day when it was down about 3%, had retraced about half of the gain that it had made from the COVID low in 2020 to its peak in January of 2022. In technical analysis, we call this a Fibonacci retracement level, and the 50% Fibonacci retracement level is a big one. When that level was hit, it appeared to set off a wave of profit taking and put options that had become profitable. I was one of those people who took profits in my put options with a 159% profit on my Apple put and a 107% profit on my Nasdaq put. By the way, if you want to know everything that I buy and sell, I post all of my trades on Twitter free of charge. You can follow me on Twitter and follow my trades at twitter.com/realscottcurry. That's twitter.com/realscottcurry. The profit taking and put options caused a gamma squeeze, which translated into actual buying, especially as those who were short the market got squeezed. So in short, the market hit a technical level, which was the 50% Fibonacci retracement level. That triggered a profit taking on put options, which in turn triggered a gamma squeeze, which caused stock prices to go up. That in turn caused margin calls on people who were short. So all in all, this was a technical rally on Thursday. And you have to understand, sometimes markets move more because of positioning and trading, not for any fundamental reasons. So what was this horrible economic news that caused the stock market to open down 3% and caused the S&P to hit that 50% Fibonacci retracement level? The biggest fundamental news we got was the CPI, or Consumer Price Index data. Inflation came in higher than expected at 8.2%, and core inflation, that is the CPI minus energy and food, hit a 4-decade high. It was the largest increase in core CPI since 1982. Contributing to this rapid rise in inflation is the fact that rents rose in September at the fastest pace since 1990. In addition to rents rising at the fastest pace in 32 years, mortgage rates also hit 6.92%, which was the highest in 20 years. And the inflation expanded beyond the supply chain issues over into the service sector. This is what caused core CPI to rise so much, is that core service prices jumped in September, driven by shelter, medical care, and car insurance. So overall, the inflation report that we got on Thursday was much worse than expected and was generally horrible for the economy. The inflation data not only triggered an initial sell-off in stocks, it also triggered a big sell-off for U.S. Treasuries. And remember that as Treasury prices go down, bond yields rise. The U.S. 10-year Treasury yield closed at 3.95%, which was the highest in years. And as inflation and bond yields rise, this pushes the stock market down. In addition to all of that news, jobless claims rose to 228,000 for the week, which was slightly higher than forecasted expected, pointing to layoffs increasing. Shockingly, despite all of this negative news, the market is still pricing in the Fed pivoting and slowing down their rate of rate increases. Unfortunately, it's a pipe dream that is highly unlikely to happen. The CPI inflation report that we got on Thursday pretty much seals in the case for a 75 basis point rate hike in November with a possible higher 1% rate hike. When the stock market finally wakes up and realizes that the Fed is not going to pivot, that they're going to stay on course and continue to do the rate hikes, this is going to cause the stock market to eventually fall, and we will easily hit new 52-week lows. Keep in mind that the Fed has their next rate hike meeting on November 2nd, which is just a little under 3 weeks away. As those rate hikes continue, this is leading us closer and closer to a major recession. 76% of adults are now making lifestyle changes in order to prepare for a potential recession. 84% of adults in a recent survey said they are concerned about a recession happening before the end of this year. Not the end of 2023, before the end of 2022. The number one financial adjustment is delaying major purchases such as a house or car. That's followed by paying down debt and planning to cut back on holiday spending. As consumers cut back on holiday spending and delay the purchase of major goods, this is going to cause earnings to continue to decline, and we could see retail sales, banks, and many other earnings go down significantly in both this quarter and next quarter. Earnings season starts on Friday with the banks reporting, followed by technology companies next week and retail companies shortly thereafter. All of this could cause the stock market to go down significantly. The one thing we have not yet seen in this bear market is a significant reduction in PE ratios or price to earnings ratios. That is the share price divided by the earnings price. As earnings continue to go down, we should see share prices go down to match. And so far, we have not yet seen that. We've seen share prices come down, but we have not yet seen the PE ratios come down. And until that happens, we're just not going to hit a bottom on this market. And since earnings do start on Friday and they will run for about a month and a half, this could finally be the earnings season where we see that price reduction in earnings, and we could finally see the stock market making a major sell-off due to earnings. All of this is causing people to bet that the market will collapse soon. The number of people buying put options has ballooned over the past few days, and it looks like large retail investors are preparing for a major collapse in the price of US stocks. Now, this would make sense given the extremely high inflation report that we got on Thursday, the fact that the Fed is most likely going to have to raise interest rates at an even faster pace than they've already said that they're going to do, the fact that earnings are declining, unemployment is rising, everything about the US economy is terrible, we're about to enter a major recession, and all of that fundamentally points to the stock market going through a major crash sometime very, very soon, even though over the next few days, we could see the stock market rise just due to the technicals before we finally get that sell-off next week. So keep your eye on the technicals in the very short term, but starting next week, the fundamentals should start kicking in, and we should start seeing stocks drop to new 52-week lows. That is the reason why I loaded up on put options on Thursday, expecting the stock market to start selling off very, very soon. If you enjoyed this video and got a lot out of it, be a good friend and share this video with your friends and family so that they can learn about how the stock market works as well, and they will also understand why the stock market went up. And also hit that like button and subscribe. And if you want more great market insights like this and you want to know where the market might go over the next few weeks and months, make sure you watch the last video that I uploaded here.